Okay, so today we're looking at taxation. Yeah, so taxation is interesting. It's quite interesting, and it's one of the easiest, as I've already put it. So this is a topic that we're going to look at today. Is a fundamental topic. I think by far it's the most important, or if not one of the most important. Otherwise, the concepts that you need to understand about taxation, we're actually going to learn them today. So just make sure you pay attention so that at least you are sure that you are ready for the exam. Because this topic is quite important. It's the foundation, or in other words, it's the anchor or the spine of taxation. So yeah, let's begin. So now, so taxation in an exam, when you're approaching taxation questions, there are three steps that you need to take. So these steps are in form of questions. So it's not always that the examiner is going to carry this approach, but for the most part, this is the way the approach is outlined. And you, whenever you are solving a taxation paper for your own sanity, or for your own safety, or for your own easy tackling of the paper, you need to follow these steps. So step one, you need to first calculate the capital allowances. So in most questions, when they ask when it's maybe, let me say, question one, the first thing that they ask is calculate the capital allowances. So once you know how to calculate the capital allowances, you can hammer the whole, maybe 15 questions, 15 marks, 20 marks, you can hammer all of them. Then after that, you need to compute the taxable profit. So on the taxable profit, this is where we have a non-taxable expenses, and the taxable expenses, and the non-taxable income, as well as the taxable income. So this is where we first we calculate the amount that we're going to charge tax on. Then three, this is where you compute the taxable profit. So after you calculate the capital allowances, then you compute the taxable profit. Then from the taxable profit, you deduct the capital allowances. Then from there, at the end of the section, obviously, maybe part C of the question, you'll be told to calculate the taxable profit. So now let's begin. How do we calculate the taxable profit? So usually unincorporated businesses, so this is the sole trader and the partnership, right?
Yeah.
Uh, who have turnover of less than 800,000 per annum are subjected to turnover tax. So all those companies with turnover, or an annual turnover of 800,000, or let me say less than 800,000, these ones, they pay turnover tax, and turnover tax is just about, I think, 5%, if I'm not mistaken. But those that earn,
4%.
it's 4% now. Huh?
Yeah.
Yeah. So turnover tax is 4%. So now, those companies that earn 800,000 and above, those are the ones that we need to use this format that we're going to use. These are the ones that use tax bands. But for unincorporated businesses which earn less than 800,000, these they pay turnover tax. So the only expenses which are taxable are those which are incurred directly for business purposes. So all the expenses that we incur for business purposes, and business purposes exclusively and only, these are the ones that we allow for tax purposes. So capital income is non-taxable. So all the capital income, we've got non-current asset. We sell that non-current asset. That profit that we get, that profit is not taxable for tax purposes. And some other thing that you need to know is some expenses that are deductible for accounting purposes. For instance, depreciation. Depreciation is not allowable for tax purposes, because the tax authorities, ZRA, says depreciation is not a real expense. Amortization is not a real expense. So for us, we're going to add it back to the net profit, so that we can charge taxation on a larger amount, as opposed to an amount which is net of depreciation, which is not a real expense, because depreciation is just, it's a notional expense. There's no money that goes out of the business, but for accounting purposes we deduct it from the gross profit, right? So
Yes.
the ZRA refuses, saying no, that's not an expense, we need to add it back to the gross profit, or let me just say to the net profit. We need to add it back to the net profit so that we can have a larger amount, which is more accurate, so that when we hammer you with our tax, we'll make sure we get a large amount. So now, non-deductible expenses are added back to net profit. So non-deductible expenses are basically those expenses which are not allowed for tax purposes. So we add them back. Then non-taxable income. So this is income that is not taxed. For instance, profit on depreciation. Profit on depreciation is basically a capital income, and capital incomes, according to ZRA, we're not supposed to charge tax on them. So this is why we need to deduct them from the net profit. So the net profit is arrived at by adding for instance, the profit on disposal. But ZRA says no, we need to deduct the profit on disposal so that we can arrive at the amount that we need to charge as tax. So now let's look at the deductible and non-deductible expenses. So let's look at first capital expenditure. So for capital expenditure, depreciation is not deductible. So whenever you're calculating, whenever you're solving a question, when you find depreciation as an amount which was charged to arrive at the net profit, you need to add it back to the net profit, because depreciation for tax purposes is non-deductible. It's not an expense that's recognized by ZRA. Then two, loss on disposal is non-deductible. This also has the same effect as depreciation. Uh, um, ZRA says this is not a loss that we can recognize, so the loss on disposal is non-deductible. We need to add it back to the net profit so that we can arrive at the taxable income or the taxable profit. Then expenditure to improve the earning capacity of an asset is non-deductible. So this is basically this is a capital expenditure, so a capital expenditure which is spent to improve the earning capacity of an asset. ZRA says we don't need to deduct it for non-deductible. You need to add it back to the net profit. Then profit on disposal is non-taxable. So this is a capital income, and ZRA says capital incomes are not supposed to be taxed. So when you see a profit on disposal, you need to deduct it from um, from the operating profit, which has been adjusted for all these operational non-deductible expenses. So we need to deduct uh, profit on disposal and some other incomes, as you are going to see when we start looking at the non-deductible incomes. Then two, inventory to owners. So sometimes in a business, the owners of a business can get some of the inventory. So maybe we sell phones, then I don't have a phone, right? I can get one of those phones and start using it for my own personal errands, for my own purposes, but not for business purposes. But ZRA says if, yeah, so for my own purposes. But now here we're going to look at the incentives that go to the owner. So for instance, salaries, right? So for salaries, ZRA says salaries of owners and interest on capital are non-deductible. So whenever you see in a question that the owner was paid such and such an amount and an interest on capital, this is largely for partnerships. These expenses are non-deductible. You need to add them back to the net profit. And sometimes there are cases where a family member works in the business and then they are paid a salary, but the salary is not equal to the amount of the salary that is paid to other employees. So you've got maybe 3 employees. Then one of the 3 employees is a family member of the owner of the business. Then 2 employees are paid 2,000. Then the other employee is paid, the family member employee is paid say 5,000, but they're doing the same job. that amount of expense is not deductible for tax purposes. So I've seen it in one of the questions. When you see that, you have to know that it's not deductible. So transfers to reserves are not deductible as well. So when you see such and such, maybe 50,000 was transferred to the reserves, then it is treated as an expense. It is not deductible. You need to add it back to the net profit. Are we together?
Yes.
Yeah. So now, what about the goods taken for personal use? So I went ahead of myself. I started giving the example of the phone on this point. So now let me carry on. So for instance, we've got a business. We sell phones, right? Me as the owner, I've got the right to just get one of the phones and use it for my own personal errands, right? So if I get the phone and it's treated as an expense, saying, okay, this phone was taken by the owner, then it's expensed to show that the inventory went out of the company, right? But for ZRA purposes, that is non deductible. It's not an expense according to ZRA. Then the amount that has been taken out of the business must be included at the market value, not at cost. So if the cost of the phone is 4,000, then the market value is, let's say, 4,500. So obviously the market value is the selling price. So what they're trying to say is when we are adding back, we don't have to add back the cost, even though the business deducted the cost value of the good, but us we have to add back the market price. So if you are given a cost, right? You say no, the goods that were taken out of the business cost maybe 5,000, right? Then they'll tell you the profit margin is 20%. What you have to add back to the net profit is the amount of the cost plus the profit. Then that's going to be the selling price. So our focus is the selling price. When you get that selling price, you add it back to the net profit so that we can arrive at the taxable income. Then four, irrecoverable debts and provisions. So sometimes in businesses, you lend out loans. You understand this very well. So sometimes you can lend out loans,
Yeah.
but there's a provision saying, oh, perhaps we can have bad debts, right? And we can have irrecoverable debts. So now ZRS says if you've got an irrecoverable debt in your business, it's deductible. It's fine. You can deduct it as an expense. We don't mind, increase in specific provisions. This is a provision. I'm sure you heard of a provision. This is where you provide. It's the other day we're discussing IS 37, which is provisions and contingent liabilities. So where you make a provision saying, okay, perhaps maybe 50% of our sales of our receivables are going to be bad debts. It's just a provision. We don't know if it's true or not, but we're just making a provision. Given our experience running the business, we can say, oh, maybe 20% of our receivables can be bad debt, right? So now, what ZRS says, an increase in specific provisions is deductible. So if it's a specific provision saying maybe 20% of the debts from maybe a specific customer, like we have a customer like maybe Zambif. We say maybe the debt from Zambif can go bad by a specific amount. If I've got a specific amount, instead of saying 20%, but we've got a specific amount of provisions, these the increase is deductible. So the point here is increase in specific provisions is deductible. Then a decrease in specific provisions is taxable income. So if it's taxable income, whenever you see a decrease in specific provisions, you don't have to do anything with that information. You just leave it as it is. But ZRA says general provisions are not deductible. So instead of specifying the amount of provision, instead of saying maybe the provision is out of our total receivables of 100,000, the specific provision is okay, maybe 20,000 are going to go bad. That's a specific provision. But the general provision says, oh, maybe 30% of those debts are going to go bad. So it's not specific, but it's general. So those general provisions, they are not deductible for tax purposes. Are we together? Hello? Hello? Okay, I hope you're getting me. Oh, I can carry on. Okay, all right. I've read your message. Okay, all right. Let's continue. Okay, so now what if we've got non-trading debts? This is where we are a company. Uh, we sell phones. I'll go back to the phones example. We sell phones, but we lend money to our customer. Maybe we lend our customer 5,000. You know, but that amount that we lend our customer is not deductible for tax purposes. ZRS says this amount is not deductible, but those dates that were written off, so maybe we think the customer won't pay us back the money, then we write it off, and then subsequently the amount is paid back. That amount is not taxable income. So what we have to do, we have to deduct it from the net profit so that we can arrive at the taxable profit. Then six, theft. So what if a director steals from the business, right? So if a director steals, that's an employee with control in the business, that amount is non-deductible. So no matter how much or how small, so long as it's a person with control in the business who acted with dishonesty and stole money, that amount is non-deductible. Then, but an employee who doesn't have control, an employee who is at the operational level, they're just following orders, they don't have any control. When they steal, the amount of money that they steal or the goods value that they steal, that's deductible for tax purposes. So this that is non-deductible, we add back to the net profit so that we can arrive at the taxable profit. So now, legal and professional fees. The ones that are deductible are those incurred directly for trading purposes. So if we incur legal fees for trading purposes exclusively, those are deductible for tax purposes. Professional fees and legal fees relating to non-accounting or to normal accounting work is deductible. I'll say it again, professional and legal fees relating to normal accounting work is deductible. So e.g., tax returns and agreeing tax liability. So if we pay an accountant, we pay, say, an accounting firm, we pay maybe PKF to prepare our tax returns. Those professional fees, they are deductible for tax purposes. Then if we get sued by ZRA, maybe if we're not paying our tax, then we need to pay a lawyer. Maybe we pay Makebi Zulu and Associates to stand for us at the tax tribunal. Those expenses, they're deductible for tax purposes because they are legal fees that are relating to agreeing tax liability. Then costs incurred in defending title in existing non-current assets are allowed for tax purposes. So if, for instance, we sell our phones, the phones that we sell to a customer, then the customer is taking long to pay us, he owes us 5,000, then we take that person to court, we pay Makebi Zulu and Associates, they stand for us in court, then they help us recover our money. Those costs relating to those legal fees that are relating to us defending title in existing non-current assets are allowed for tax purposes. So I'll stop here and I'll ask if you've got any questions so far. Do you have any questions? Okay, so let's carry on. So now, what about lease payments and hire fees? So we are in a lease, we're in a operating lease. Then we've got the interest that we pay on the operating lease, or the lease payments that we pay, or we're in an did I say, oh no, we're in a finance lease. We're in a finance lease. Those lease payments that we pay, those lease payments that we pay for having a lease payment or lease contract rather. So those payments incurred directly for business purposes are deductible. So the keyword is directly related to business purposes. So everything that's related to the business and management of the business, or incurred expenses pertaining to lease payments and hire fees that are directly incurred for business purposes, these are deductible for tax purposes. Then nine, gifts and entertainment. So where we give gifts to customers and suppliers, ZRA says these expenses are non-deductible. We buy clothes, we buy food for our suppliers and our customers. According to ZRA, any entertainment expenditure and gifts for suppliers and customers is non-deductible. Then expenditure on entertaining employees, ZRS says this is deductible. Why? Maybe it can be motivation for those employees. So entertainment of employees is deductible. Then gifts to customers are only allowed if the company benefits in form of advertisements. So maybe we sell phones. I'll go back to the phones example. Maybe we are what's the famous, we are mobile city, then us as mobile city, we print out shirts, and then shirts that have got the mobile city name on it. Then these shirts we give them to our customers as gifts. So those gifts are allowable for tax purposes. Why? Because we're benefiting as mobile city in form of advertisements. Then gifts which are not related to advertisement, just gifts, they must not exceed 100 kwacha per annum. This, in practical terms, unless there's a question, but this, explain it just like this, it doesn't really make sense as much, because you just maybe you give to one customer 100 kwacha, goods worth of 100 kwacha, but it depends with the company that you're running, because sometimes you can give customers goods that are worth more. But ZRA says these goods must not exceed 100 kwacha per annum, and they're going to be allowed for tax purposes. Then for entertainment and hospitality business, the entertainment costs are allowed. We've got a lodge in Livingstone, then we spend on entertainment and hospitality. We book your maps to come and perform at our lodge. Those expenses are deductible for tax purposes if we are hospitality and entertainment business. Let's carry on. What about income tax paid on profits? If we pay in tax, provisional tax, then we recognize it as an expense. It's non-deductible for tax purposes, according to ZRA. Then subscriptions. So subscriptions, ZRA says these are deductible if they relate to the business operations. So if, for example, we are a trading company, we are young Furos, then we have got a membership in the Zambia Chamber of Commerce, and every single year per annum we need to pay subscription fee. ZRA says that subscription fee is deductible for tax purposes. Then pensions and benefits, these are deductible if they are reasonable. So obviously pensions and benefits, they are deductible. Then interest payments. Interest on short-term borrowings is allowed on a cruise basis. So if you borrow 10,000 for the next 2 years, we're paying interest at 10%. That 1,000 in our books, we've only paid 1,000, we've only paid 500 kwacha. But according to the tax laws and tax purposes, we need to recognize a 1,000 kwacha for a cruise basis. Then interest paid on overdue tax are non-deductible. So if we take long to pay our tax liability, then we are charged interest by ZRA. Those are non-deductible for tax purposes. Then any penalties arising under Income Tax Act are non-deductible. If we've got interest, as I've already said, it's non-deductible. But also if we've got penalties for whatever non-compliance that we've committed towards ZRA, those are also non-deductible. Then we've got fines. Fines, maybe we've breached. So let's say we are a restaurant, we've breached the safety codes, or maybe yeah, the Ministry of Health codes for safety for I think for let me give this example. So we're a restaurant, then our premises they're not really clean, so we don't keep our kitchen clean. Then the council comes, they check, the department of council come, they inspect our restaurant, then they discover that we're not clean, then they make us pay fines. Those fines that we pay, they are non-deductible for tax purposes. Then technical education, expenditure incurred on education relating to business or obtain further education for employees of the business are allowed. We pay school fees for our employees so that they can get a master's or an MBA. That amount is deductible. If our employees are studying ZiCA, then we're paying for their exam fees. That amount is deductible for tax purposes. Then public benefit organization allowed if the amount is paid in cash or in kind. Donation is made for no benefit to entity, then the institute is approved by the Ministry of Finance. If we donate to an NGO, the amount that we need to allow for tax purposes is the value, the money value, or the payment is in kind. So the donations are supposed to be to an NGO which is registered and recognized by the Ministry of Finance. And when we donate, we don't have to expect anything in return, not even for marketing purposes. So if we donate to an NGO with expectations of marketing, then that is not deductible for tax purposes unless there's no consideration that accrues to the company for our donation. Any questions? Any questions so far? All right, okay, no questions. So let's carry on. So research and development. So if we've got research and development, so largely it's just the research expense because development costs are capitalized according to IAS 38. I'm sure you remember IAS 8, International Accounting Standard 38. Intangible assets development costs are capitalized, but research costs are expensed. So those research costs, they're only deductible if they relate to the business. Then pre-trading expenses or expenditure. So this is where we've registered our company, but we're just company promoters. We haven't really started trading. Maybe just to make sure we refurbish our, or maybe we prepare our head office just to make sure it's looking up to par. Those expenditures, they are deductible for tax purposes if they're incurred within 18, not 18 minutes, but 18 months. If then they're incurred within 18 months before starting the business. And if it could have been incurred if the business ran at that time. So if the expenses that were incurred, if the business were to run 18 months ago, if those expenses were to be incurred, if the business was running at that time, then they're supposed to be deducted for taxable purposes or for tax purposes. Then trading losses, where we make a loss and we recognize the loss, these are non-deductible. We don't have to deduct them. We don't have to add them back to the net profit. Then we have unrealized profits. So unrealized profits, an example of an unrealized profit, this is where we expect to sell something, all right? We expect to sell an asset, for instance, you know, we ex we expect to sell an asset in the next 2 months, then we recognize in advance, but that profit hasn't yet realized, so that unrealized profit is not taxable for tax purposes. Then we expect to sell an asset which costs or which has got a residue value of say 5,000, then we expect to sell it at 4,500. There's a loss that we're expecting, but that loss is unrealized. It's unrealized. So that unrealized loss, if we've recognized it, we have to add it back to the net profit so that we can arrive at the taxable profit. Then foreign exchange gains and losses. So foreign exchange gains are only taxable if revenue, right? So if you've got foreign exchange gains, they're only taxable if revenue. If not, if they are capital, if they're capital in nature, they are non-taxable. Then foreign exchange losses are deductible if revenue. So if foreign exchange losses are relating to revenue income, then they are deductible for tax purposes. Then foreign exchange losses on loan incurred for purposes of constructing a building are deductible. So these are also deductible. But these parts are out of all the questions I solved, and I solved quite a number. I never saw any adjustment which was dealing with foreign exchange gains and losses. But for knowledge's sake, that's why I included it. Then traveling expenses, they're only deductible if incurred while performing business activities. So if we incur, maybe we've got a small business, we've got a small delivery business, but we don't really have a vehicle, then we have to move to and fro. Then we book maybe a Yango so that we go and deliver our products. Those are traveling expenses and they are only deductible if they're incurred while performing business activities. So if we're going to deliver our products, then we book a vehicle. That's traveling expense, which is relating to business activities. Then donation to political parties is non-deductible. ZRA refuses if you donate to EPF or MMD or Socialist Party, so that maybe when they come into office, they give you some incentives. That donation is not recognized by ZRA. It's not an expense. Are we together? Any questions? Okay, so let's carry on. So now let's look at the non-deductible income. So non-deductible income is deducted so after we adjust, we've got the net profit, then we add back the non-deductible uh, non-deductible expenses. We add them back to the net profit, then we're going to have the adjusted profit. So when we have that adjusted profit, we need to deduct this is supposed to be non-taxable, non-deductible. This was a typing error. So it's supposed to be non-taxable income. So this is income which is not taxed. It's not really taxed by ZRA. So all incomes subject to withholding tax are non-deductible. So we've got rental income, interest income, royalties, dividends, profit on disposal, non-business loans written off but subsequently paid off. So all these, the rental income, so all these incomes, so dividends, royalties, interest income, rental income. So all these, they're supposed to be included at gross. So all the incomes, all incomes subject to withholding tax are supposed to be recognized at gross, gross, recognized at gross. So if you're given a net amount, so if you're given rental incomes, which is for the most part, they're usually net. So withholding tax is charged at source. So if interest comes net of tax, you need to adjust it so that you have it at gross. So we need the gross value, of the rental income. Okay, so now, any questions so far? Okay, all right. So now let's look at capital allowances. So now we've looked at the taxable profit. Now we're going to look at the capital allowances. Capital allowances. So capital allowances is a relief given on taxable profit which replaces accounting depreciation. So this is a relief which is given on capital expenditure which replaces depreciation. So you see, ZRA refuses. Your depreciation is not a real expense. We don't accept it as ZRA, but we're going to give you our own depreciation, which we think is appropriate because you might inflate your depreciation. So we're going to give you our own depreciation. Then this is what capital allowances are. And capital allowances, I'm going to emphasize they're the foundation of taxation. These you can hammer very good marks if you understand capital allowances. So capital allowances are given on implement, plant, and equipment. That's number one. Then two, they're given on industrial buildings. Then three, they are given on commercial buildings. Then four, they are given on farm works and farm improvements. So we're going to look at this later on in the study, largely when we're looking at farming income, calculating tax for farming income. But for this section, we're going to look at these three: commercial buildings, industrial buildings, and implement plant and equipment. So let's begin with capital allowances on implement plant and equipment. So what are the examples of implement plant and equipment? So general plant. Now we've got a general plant where we okay, we've got a general plant. For argument's sake, we've got a general plant where maybe we manufacture something, but a very small plant. Then we've got machinery as well. So in that plant, we've got machinery, right? So not really a factory, but just a small plant where we do one or two manufacturing. Then we've got machineries as well. That's also recognized that as implement plant in machinery. Then we've got fixtures and fittings. We've got our head office. Then we've got maybe shelves and all these other fixtures and fittings. These are also included in plant, implement, and machinery. Then furniture as well. The furniture that's in the maybe we're express credit. Uh, our customers come to borrow money. Then we've got tables and chairs in our office where people come. Those furniture, those furnitures, they are recognized as plant implemented machineries. Then also motor vehicles. So now, let's look at the capital allowances. So capital allowances are given on wear and tear basis. So when we're giving the capital allowances, so they are reducing balance. They're given on a reducing balance basis. So they are wear and tear. So we've got implement plant and machinery. So everything that's relating to implement plant and machinery. So we've got fixtures and fittings, furnitures, laptops, all these other office stationary equipment. My tables, my printers, my what else? Oh, I don't have a lot of ideas. Even my shelves, everything that's relating to plant machinery is at 25%. Then commercial vehicles, these are also at 25%. So what are commercial vehicles? I'm sure you know commercial vehicles. For instance, delivery trucks. You've got a truck, you've got a lorry, you've got a Tata. Because I've seen recently, I'm seeing a lot of these Tata vehicles that not very small, but they are small in size, but they're using them for delivery, delivery purposes. So commercial vehicles, these are vehicles that are not used for personal errands. So you can't take your child, according to the definition of commercial vehicles. These are not used for personal errands. You can't really go to take your child to school. You go with a delivery vehicle. So that's a non-commercial vehicle. So those non-commercial vehicles are vehicles that are used for personal errands. Those luxury vehicles. My Benz, my Mercedes Benz, my Ranex, and all these other vehicles that you can use for personal errands. Those are non-commercial vehicles. But commercial vehicles, these are used for business errands, delivering. you know, largely delivering. These are commercial vehicles, Makanta, Matata. Because I've seen a lot of these Tatas. Then machinery. So machinery that is used for manufacturing, tourism, farming, and agro processing is given at capital allowance 100%. The capital allowance, the whole cost is given as capital allowance relief. So now, what if an asset, so for instance, we've got a small business, then we've got a vehicle, let's say we've got a Mercedes Benz that is used for personal errands as well as for business purposes. It's used for both business as well as uh, um, personal errands. So that's divided use. So if an asset is used for both personal errands as well as business purposes, it has divided use. I'll give an example. In If we've got a head office, it's a two bedroom house. One bedroom is used as an office, then the other bedroom is used as a normal bedroom that is used for sleeping in. It means there's divided use, so we need to find the proportion of that room according to the number of rooms that we have in a particular house. So where an asset is used for both personal and business purposes, capital allowances claimable is restricted to business use. So the amount of capital allowance that we claim from ZRA is restricted to business use only. So the proportion of the asset that is used for business purposes is what we deduct as capital allowances. Then disposal of assets. So when we dispose of an asset, you know, in the last year that we have an asset, right? So we charge capital allowances on a wear and tear basis. We've got an asset which has got a useful life of 5 years. So for 4 years, we need to charge the wear and tear capital allowance. But in the final year, where we need to sell it off, we don't charge the capital allowance. So in the final year, when we sell it off, you know, we can either have a balancing allowance or a balancing charge. So sometimes an asset cannot be sold. It can be sold. We haven't sold it, but still we need to have a balancing allowance or a balancing charge. So the idea here is in the final year of using the business, we do not charge capital allowance, but rather there's a balancing allowance or a balancing charge. So what is a balancing allowance? So a balancing allowance arises when the disposal value, obviously, this is the value of an asset. Let me just say the residue value for argument's sake. It's a residue value. So if the residue value of an asset is less than the income tax value, what's the income tax value? The income tax value is the balance after deducting wear and tear. So the income tax value is basically the residue value for tax purposes. So after we deduct the capital allowances, then we're going to have the income tax value. Then that income tax value, we need to compare it with the disposal value, and we're going to have a balancing allowance if that disposal value is less than the income tax value. But if the opposite is true, the balancing charge is arrived at when the disposal value exceeds the income tax value. So our residue value exceeds the income tax value. Then we've got a balancing charge. So now, how do we treat them? So a balancing allowance is just the same as other capital allowances, but the only difference is the name. So the way we treat other capital allowances is the way we treat a balancing charge. So sorry, a balancing allowance. So a balancing allowance is just the same as capital allowance, but a balancing charge on the other hand is deducted. So a balancing charge is a positive, you know, but a balancing allowance is a negative. So a balancing charge is deducted from all these other capital allowances. So all these other capital allowances are positive, but this one, the balancing charge is supposed to be in brackets, signaling that it's a negative. Then disposal value must not exceed its cost. All right. So for instance, we've got an asset that's valued at 1,000. Then we are selling it off. Maybe the income tax value is 50. So from 1,000, the income tax value is 500. but we're selling it off. We sell it off at 120 kwacha. ZRA says no, we need to restrict the disposal value to the cost. So if you have that scenario, then you have to get the disposal value as the cost of the asset. Then you divide you deduct the income tax value from the residue value, which is consistent with the cost, which is just the same as the cost. Then you're going to have the balancing charge or balancing allowance depending on the particular situation. So if the asset has divided use, capital allowance claimable is restricted to business use. So capital allowance is restricted to business use. And this is something that you need to understand and understand very well, because in questions, you're going to find this where an asset has got divided use, it's used for personal as well as business errands. And you have to restrict capital allowance claimable to um, business use. So even expenses that are incurred for both personal and business purposes, I will emphasize on this, restrict the expenses to business use. So only expenses that are used for business purposes that have got divided use, you restrict to the proportion of the business use. Even capital allowances is the same. I'll emphasize and emphasize again. This is very, very important. Then lease and hire purchase. So for a lease, for a finance lease, capital allowance is claimable. So a finance lease is based, we're going to look at this in IFRS 16, which is tomorrow. So a finance lease is basically a lease where you get an asset, then you treat it as your own. You treat it as it's your own asset. The risks and benefits associated to that asset, they accrue to you, who is the holder of that finance lease. So it's treated as your own asset, and capital allowance is claimable. But for operating lease, this is where you just get an asset, but the costs and benefits associated with that asset accrue to the owner of the assets. Then this is not claimable for tax purposes. Capital allowance is not claimable. Then for hire purchase, capital allowance is claimable at the contract cost. How much have we bought the assets on hire purchase? That's what we recognize as the cost. I don't know if you've got any questions for what we've covered so far.
No questions.
No questions. Okay. So now let's try to go through a question. So that
Okay.
I give you a demonstration of how we're supposed to solve the question.
Okay.
Okay. You can see my screen now.
Yes.
So this is an example. At the beginning of the year 2023, right? DTCO had the following assets at cost. So it's supposed to be cost. Had the following assets at cost, right? So office equipment was 2,000. You can see my Excel.
No, I can't see your Excel.
Can't see my Excel. Okay.
I can just see the example.
Okay.
Yeah, it came, it has disappeared again.
Game, it has disappeared. Can you see it now?
Yeah, it came.
Can you see it now?
No.
Okay. So I'm going to ask you to keep the records of this information that we have. Okay. So DTCO had the following assets at cost. Huh? So office equipment was
Yeah.
2,000. Keep that amount for me.
Okay, let me write it somewhere.
Because yeah.
Okay, yes, 2,000.
That's the office equipment. Then Benz motor car, 200,000. And it was
Okay.
purchased. It was purchased 3 years ago.
Okay.
Then delivery truck, 80,000.
Okay.
Then Toyota Ranex, 450,000. It was purchased 2 years ago.
250,000. 45,000.
Yes, 45,000 for the Ranex, Toyota Ranex.
Okay.
Then we've got equipment at the cost of 10,000. It was bought last year, 2022.
Okay.
Then as of December 2023, the company sold the Benz. The Benz was sold for 80,000.
Okay.
Then the equipment was sold for 5,000.
Okay.
So now calculate the capital allowances. So let me share my Excel so that we can do it.
Okay.
Okay, can you see my Excel?
Yes.
So give me the data. What do we have? I remember we've got office equipment.
2,000.
Office equipment.
The amount is 2,000 for office equipment.
2,000. Okay.
Then the Benz,
Benz.
200,000
Okay,
was
Benz.
bought 3 years ago.
200,000, right?
Yeah, which was bought 3 years ago.
200,000 years ago.
Yes.
Years 3 years ago. Then the other one,
Delivery truck, 80,000.
delivery truck, 80,000. How many years ago?
There was no use for this one.
Okay, which other one?
The Ranex, 45,000.
The Ranex. Ranex. Okay, just a minute, huh?
Okay.
Ranex. 45,000.
Yes. Was bought 3 years ago.
The Ranex.
Yeah.
3 years ago. Okay.
Equipment
Equipment.
at 10,000.
Okay. But I think the Ranex is 2 years ago.
2 years ago.
Yeah, not yeah, 2. Then other equipment, eh?
Yes. Then we
Other,
have other information as well.
wait, other equipment, how much?
Other equipment, it's 10,000.
10,000.
Then we have the Benz was sold at 80,000.
Okay. So Benz 80,000, huh?
Yeah, was sold at 80,000.
So
Then equipment at 5,000.
so the equipment is the office equipment, huh?
Yeah.
So I think this is the other, not the office, but other equipment. Okay. So the other
Okay.
equipment was 5,000, huh?
Mm.
5,000. So we've got that data, eh? So we need to work with this. So now when we're calculating capital allowances, this is the format that you use. So here we've got item. We've got the item, right? Then here
Yeah.
we've got quarter, and here we've got also quarter. All right. So first one, the first item is office equipment, right?
Yeah.
Office equipment. So the office equipment at the cost of how much?
At 10,000.
10,000, right?
Yeah.
The first office equipment, not other equipment, but office equipment. So this is 2,000 here. You can see it, huh? Hello?
Hello, I'm getting you.
Yeah, so this office equipment is here, 2000, right? That's
Yeah.
the cost. The cost is 2000, right? So now this is the next thing that you need to calculate is the wear and tear allowance, right? So the wear and tear allowance is calculated by the cost, right?
Yeah.
So now let me ask you this if you're following. Office equipment, what's the capital allowance rate for it?
For equipment,
Yes.
is it not supposed to be 10%?
For equipment, no, for equipment, it's 25%.
Okay.
So 20,000 times 25%. Can you help me with that? Do you have a calculator close?
Yes.
So 20,000 times 25%, or 2,000 times 25%.
2,000
Times
times
25%.
0.25.
Yeah.
That's 500 kwacha.
So 500 kwacha, that's the capital allowance, right?
Yes.
So in this column, we put the capital allowance. Capital allowance. So that then we deduct this amount. The 500, we deduct it from 2,000. Huh? We're going to have 1,500, right? Are we together?
Yes, we are together.
We're going to have 1,500. And that 1,500 is what we call the income tax value. The following.
Yes, I'm following.
Okay. Then what's the other thing? The other item that we have? The second
So we have the bins.
Benz. What's the cost of the Benz?
200,000.
The Benz is valued at 200,000. Huh?
Yes.
200,000. What do we do next? 200,000. We need to deduct the wear and tear allowance. All right.
Yeah.
So now this Benz, we bought it for 200,000 kwacha. This 200,000 kwacha is the cost 3 years ago. So it means in the past 3 years, how many capital allowances have we had? We've had 3. You understand? So there's the first capital allowance in the first year, in the second capital allowance in the second year, then there's the third capital allowance in the third year. All right? So now we need to calculate the capital allowance. You said 200,000. 200,000. You multiply this by what's the rate for a non-commercial vehicle?
And commercial vehicle. 2%.
For a non-commercial vehicle, it's 20%.
Okay.
So yeah. But anyway, don't worry. These things are there even in the paper. Like when you check the formula sheet, they are there in the formula sheet. You don't really have to worry as much.
Okay.
Yeah. Then so now this is where I want you to pay attention. So we've got 3 capital allowances which have passed, right? In the first year, the second year, and the third year. So now this capital allowance that we calculate by multiplying by 20% is just for 1 year. But we've got how many? 3 pending. So you multiply that by 3. So what's 200,000 times 20%?
200,000
Yeah, times 20%.
times
Then
0.20. 40,000.
Then 40,000 times 3.
120,000.
120,000. Right? Yeah. So now we deduct this 120,000, 200,000 minus 120,000. How much is it?
That's 80.
That's 80. What is happening? Okay. He said 100. No, what have I done?
You said 200,000, deduct 120,000.
Yeah. So what's the answer? 120.
80,000.
Then times 3.
80 times 3.
Yeah.
240.
Oh, it's 240.
Yeah.
So I said 200,000 times 20%. How much are we finding first?
200,000 times 20%.
Yes.
0.2. 40,000.
Then times 3.
120,000.
Yes. So we've got 120,000 there. So that's the total capital allowance that we need to deduct here. So now 120,000 or 200,000 minus 120,000 gives us what?
80,000.
80,000, right?
Yeah.
Okay. So how much? So now, with this, what we've done. So let's try to put this at 60. No, try to put it at 85 so that we can have a number that we can work with. So how much was the Benz sold at? So this is the income tax value.
Yeah. The Benz was sold at 80,000.
Okay. So if we have 80,000, then it means we won't have any balancing charge or balancing allowance. So let's take it up to 85.
Okay.
So let's say 85,000, right? So the disposal value is 85,000. The disposal value is 85,000, right? Sorry, 85,000. So 80. So now, what are we going to find here? Because here the notes tell us if the disposal value exceeds the income tax value, it means we're going to have a balancing charge. If the income tax value exceeds the disposal value, it means we're going to have a balancing allowance. So in this case, we have a balancing charge. We have a balancing charge. So 80 minus 85 gives us 5,000, is it? Hello?
Yes, 5,000.
5,000, right? That 5,000 is the what? Is the capital allowance minus 5,000. Yeah, you're getting. You get it. Hello? Hello? Okay. I need your contribution because I want you to be helping me out. Okay. All right. Yeah. Okay. So let me just wrap it up. So this is how you do it. So I wanted you to look at this so that you can follow through. So now this is the way that you're supposed to calculate capital allowances. You've got here the cost, then you deduct the wear and tear allowance, then that's the capital allowance, right? Then the cost minus the capital allowance gives us the um, income tax value. Then if you sell the asset, you've got a disposal value. A disposal value minus the income tax value is either going to give you a balancing charge or a balancing allowance. Then that's what's supposed to be recognized as the capital allowance. This is just, you can try it out at your own time, but this is just an example I wanted to give. So can we carry on? All right. So now let's look at industrial buildings. Capital allowances on buildings, right? So we've got buildings are classified into two. There are industrial buildings and commercial buildings. So now we're looking at capital allowances on industrial buildings. So industrial buildings, we've got what we call the qualifying buildings. So qualifying buildings are buildings that are used for industrial purposes. For example, manufacturing, milling, storage of raw materials or finished goods on import or for export. Then you also have hotels. Hotels are also treated as industrial buildings. Then low-cost housing. So low-cost housings, these are buildings built to provide housing for the purpose of the business. For example, a staff um, a staff canteen. So where I'm sure you know what the staff canteen is. So where like staff members have lunch, something like that. Then staff canteens they qualify if each cost is less than 20,000. So for a staff canteen to qualify, it has to be costed at less than 20,000. If it's more than 20,000, then you have to restrict. We don't care if it costed 80,000, 70,000, but the capital allowance, the cost is supposed to be restricted to 20,000. So if the cost of the staff canteen or low cost housing is 50,000, all we have to do is getting the 20,000. We need to get this 20,000 and then we charge capital allowances to that amount. Okay, so now then we also have non-qualifying buildings. What are non-qualifying buildings? For the most part, non-qualifying buildings are just um, non-commercial buildings. Oh, sorry, commercial buildings. So basically, um, non-qualifying buildings are commercial buildings, right? So non-qualifying buildings for industrial purposes, they are commercial buildings. So, for example, dwelling houses, rental shops, showrooms, offices, buildings used for retail trades, repair, and administrative buildings. All these are non-qualifying buildings for industrial purposes. So now we also have what we call a qualifying cost. What's a qualifying cost? This is the cost of an item upon purchase. So when we purchase an asset, we purchase a building at maybe 170,000. That 170,000 is the qualifying cost. But if we construct, what is the qualifying cost? If we construct is all the cost attributed to the construction less cost of land, where the building has both qualifying and non-qualifying components. The non-qualifying cost is included if it's less than 10% of the value of the building less land. So basically, when we construct land, the qualifying cost has to be net of the value of the land. So the value of the land has to be deducted from the total cost of the building that we construct. I don't know if you have any questions so far. Oh, sorry. So I thought we've moved. Okay. All right. All right. Okay. Okay. All right. So yeah. So we're looking at capital allowances, huh? We're looking at the capital allowances. So we talked about the qualifying buildings. So these are buildings that are used for industrial purposes, manufacturing, milling, storage of raw materials or finished goods on import or for export. Then we've got hotels. Then we've got low-cost housing buildings built to provide housing for the purpose of the business. Then, e.g., staff canteen. Then we've got so I said staff canteen only qualifies if it costed 20,000. If it's more than 20,000, we have to restrict that amount to 20,000. Then non-qualifying buildings, I said these are dwelling houses, rental shops, showrooms, office buildings, and other buildings that are used for retail trades. Then I also talked about the qualifying cost. What's the qualifying cost? The qualifying cost is the cost of an item upon purchase. Then when you construct, the qualifying cost is all the cost attributed to the construction less the cost of land. Then where the building has both qualifying and non-qualifying components, the non-qualifying cost, or rather the non-qualifying component, supposed to be the non-qualifying component. The non-qualifying component is included if it's less than 10% of the value of the building. Are we together? Are we together? So that, and this is an example of how to calculate the qualifying, how to include a non-qualifying component of a building that's both which has both the qualifying and non-qualifying component. But I wanted this to be interactive because this it's going to be difficult to see if you're following or not. But you should try it where because we said um the so where a building has both the qualifying and non-qualifying components, the non-qualifying component is included if it is less than 10% of the total value of the building less land. So here we've got an example saying DTCO recently constructed a building costing 1,450,000. The cost of the building consists of the land, 100,000, the showroom, 250,000, then the main factory, 800,000, right? So now let me go to my Excel. Okay, I restart from where? Hello? Okay. Okay. But can you get me? Okay. I think um. What? Hello. I think try to go on this setting. Test speaker and mic. Hello.